This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our first session here in Chapter 2, we saw this, the income tax computation. And that income tax computation comes in two parts. The first bit of which now we've dealt with and hopefully you've been thinking about and practicing on since last we spoke. And that is calculating the figure of taxable income. What does it require us to do? List out every source of taxable income in a usual order: earned income before unearned, i.e. investment income, and then critical, rather more important than the listing order itself, is the analysis of that income. That income needs to be analysed into non-savings, savings and dividend. Dividend income, obviously the name is very appropriate to it. It is, of course, the dividends that we've received. Interest income, savings income, of course, there, listing out all those different sources of savings income that are taxable. Principally, your bank deposit interest, your building society interest, government security interest, corporate bond, i.e. loan stock or debenture interest there. But as we mentioned last time, and we'll see in but a moment's time, there's a few sources of income that are indeed exempt. And most importantly there is certain sources of interest income, savings income. Non-savings income, of course, everything else, your earned income, whether it's employment and or trading profit, and of course the property income as well. We also had various possible deductions deriving and coming from those sources of income. The first one, if a trading loss had been brought forward from a previous poor performance within the business, and that would now automatically go against the trading profit assessment of this particular tax year. Remember there, of course, we prepared this income tax computation for the tax year. For us, 1920, 6th of April 19 to 5th of April 20. We also have deductions from total income. The qualifying interest, we'll see that again a little later on in this chapter, and various other trading loss reliefs. Now, what we mentioned last time was that if in fact in this tax year, for the trading profit assessment period, there was in fact a trading loss, then we put a nil assessment in at the top of this computation. And then one of the options that we would have to be able to enjoy an immediate use of that loss would be to put it against total income of the taxpayer for the current tax year. Now, of course, that would depend on how much, if any, of those other sources of income, other than just trading profit, which of course is a nil assessment here, that the taxpayer may have. So it's an option, but if of course the individual had very little, if any, other and therefore total income, it is not a claim that you would make. Not a claim that you would make, you'll remember, because the personal allowance, that was a deduction of, usually for our tax year, £12,500. Well, if you had total income there of £10,000, there'd be absolutely no point making one of these loss relief claims here, because you won't pay any tax on this tax year's income, because your personal allowance would be bigger than that total income. And those are issues that we have to consider again when dealing with loss reliefs in Chapter 7. We'll remind you of all of this at that point in time. So the deductions from total income down to net income, take away your personal allowance, that gives you taxable income there. Okay, now we mentioned a moment ago savings income, i.e. interest income, and indicated, as we see here now in section 2.1, that there are certain sources of exempt income. Now, as you can see, there aren't many that you need to be aware of. The ones that we usually get: interest or bonuses on national savings and investment certificates. Now, there is a national savings and investment bank, a national savings bank, and that you can have an account in, and an account could indeed earn interest. If you see National Savings and Investment Bank account interest, that is taxable. There is the important word here, certificates. They may abbreviate National Savings and Investment to NS&I. National Savings and Investment Certificates, that's the exempt one. National Savings and Investment Bank Account Interest, that is taxable like any other bank account interest. Next one. Interest and indeed dividend income that falls within an individual savings account, or ISA as we will know it. Again, in years gone by, what the government did was to set up these ISAs to encourage individuals to save rather than just spend. And the way to encourage saving is, of course, to ensure that the income derived from it is not then going to be charged to tax. Clearly, an incentive there to save. Now, given the things that you'll see within this chapter, the benefits of the ISA have, for most taxpayers, been taken away by other generous changes when it comes to the taxability of savings and dividend income. We will see that you could indeed have significant amounts of savings income, interest income, and dividend income. And given the more recent changes in terms of our tax legislation, that would mean that you won't pay any tax on them either. But here, if you want to get it exempt, ISAs. Again, just towards the end of this chapter, there's a little section on ISAs that tell us the limits of what can be held within an ISA for any particular tax year, the contributions that you can make into it for a tax year. Now, that was set up to encourage individuals to save, which means it might look a little bit odd when we look at the next one, gaming, lottery and premium bond winnings. Now, don't worry about what premium bonds are. Again, it's effectively a way of gambling, but through putting money into the government. You buy premium bonds every month. There is then a prize draw, and if your number comes up, you win money there. So it would seem odd to encourage taxpayers to do something that isn't really a good idea, betting. So this reason for this particular exemption, it's not a basis of trying to encourage a certain behaviour amongst taxpayers. What it is that when people gamble, do they usually win? No, they don't. They usually lose. So if we were to tax winnings, then we'd also have to allow losses. And that wouldn't be a very good idea, because sadly, the world over and in the UK, there are people that are losing thousands and thousands of pounds each year through gambling. That, therefore, would mean that if we're going to tax the winnings, we'd have to give relief for losses, so HMRC would be worse off overall. So there's method in their madness here. But any of those that you see, those are exempt sources of income. Right. If you are doing a Section C question, the constructed response question, and it requires you to prepare an income tax computation, and you see listed one of these sources of income, then it will not be included on the computation, or if you wish to, you can include it on the computation, and then write next to it exempt, so there's no income figures going in, or if you choose not to put it on the computation, then at the bottom of the computation, you put a note to the examiner saying that this particular, say the interest on the ISA or the gambling winnings there are exempt sources of income and therefore not included in the income tax computation. So in Section C, written question, written answer, if you have something that is exempt, you make a note of that in your answer. So the examiner is aware that why it is not on your computation is because you know that it is exempt. It isn't, therefore, simply because you didn't know what to do with it and you left it out. You positively tell the examiner this is exempt. If, of course, you're doing a Section AOT question and you're trying to calculate a taxable income or a tax liability and there's exempt source of income, you just leave it out. There is nothing to do. There are no workings there. In your calculations, you work out what is the taxable income, what is the tax liability, and hopefully you find that as one of the four figures given for you to choose from, and you go with it. There are no explanations, of course, there. But in Section C, provide that explanation, please. And so we move to the calculation, that would firstly be, and in most requirements, is only that of tax liability. Well, it's simple. We've calculated already the taxable income. Next part to compute either, as we said, tax liability and or tax payable, though usually it is the tax liability. What is this tax liability? It is quite simply the calculation of income tax that it's expected to be on the taxable income. So you might be thinking, well, that's pretty obvious, isn't it? You've got your taxable income and you now calculate the income tax on it. That's the income tax liability. So what's the income tax payable? Well, what that is your income tax liability there, less a reduction. And that is for any tax already deducted at source. Now, the only remaining within the legislation that we currently have source of income where tax is deducted at source is on employment income, where employers are required to operate a system known as the pay-as-you-earn system that you will recognise in future as PAYE, pay-as-you-earn. Basically, HMRC are very clever here. They get employers to do the dirty work of tax collection for them. Employers do it at source. So an employee will have a gross salary. Maybe that gross salary is £36,000 per annum. £3,000 per month, and that is paid each month there. But when it is paid, the individual does not receive their gross salary. They receive a net income after deduction of relevant taxes. The primary relevant taxation is this income tax. So the employer does the job of inland revenue, that takes me back 30 years, of Her Majesty's Revenue and Customs for them, collecting the tax at source from each of their employees and then pays that over, usually on a monthly basis, to HMRC. And that is a very efficient way for HMRC to operate. Otherwise, they'd have to go chasing tens of millions of employees every tax year to get the amount of income tax due by them into their HMRC coffers there. It doesn't make sense. So employers do it for them. The system, pay as you earn. But not only does the pay as you earn system collect income tax at source based on the level of income each month or each week if you are a wage earner, but they also collect through the pay-as-you-earn system national insurance contributions paid by employees, suffered by employees, I should say, and suffered by employers. But the employer collects all of that income tax and national insurance contributions and then pays that over to Her Majesty's Revenue and Customs. That's a huge job done for HMRC by the employers. I know they don't get paid for that. That's what they are required to do. Now, because there's only one such deduction now, PAYE, it sometimes comes up, and obviously in an odd Section A question you may see that. But the usual calculation required of you is income tax liability. Okay, so our tax liability, therefore, the main one, to be able to calculate it, as we said before, and as you'll see in this note here, it's not enough merely to know what the total income is, because there are differing tax rates that apply to non-savings income compared to savings income compared to dividend income. And not only do those sources of income have different tax rates, there are also different tax rates depending on the level of that income that you have. We have, as we mentioned in our first lecture, basic rate tax, higher rate tax, additional rate tax. So there's a whole range of different tax rates that may be applicable to an individual's taxable income, depending on two things. The amount of that income. Does the total taxable income go above the basic rate band? So you suffer not just basic rate, but also higher rate? Does it go above the higher rate band? So you suffer in addition to the basic and the higher rate there, in relation to the top levels of income, on that income alone, the additional rate is suffered. But not just different rates for different levels of income, different rates for different types of income there. Non-savings, savings and dividend. We look firstly at the taxation of non-savings income. Now, don't worry, I've said here different rates of tax for different levels of income, different types of income. The rates of taxation, the bands, the basic rate band, the higher rate band limit, all of these are given to you. The tax rate, basic, higher rate and additional rate, they are all provided to you. You have to remember and know how to analyse the sources of taxable income, but then the actual tax rates to be applied are given to you. You then simply need to know how to apply them. Now we'll build to that complete computation where you've got everything, non-savings, savings and dividend income. But we'll start with the taxation of non-savings income. We'll keep it simple. Now at this point, and throughout the remaining parts of the lectures on this chapter, I'd recommend that you have available to you, you have copied off probably there from your study notes from the rates and allowances page, that first page on the rates and allowances that gives you the information that you see here about the rates of tax, your personal allowance, and a few other bits and pieces that we'll come to in a short while as well. You don't have to memorise them, though most of them, as I've said before, by the time you hit the exam room, you will know perfectly well. But to get used to them, to stop you turning from one page to another, print off that page of rates and allowances, and we can use that as we go through. So there we go. Now, this is looking at our taxation of our taxable income. So the non-savings income that we're talking about here, we are talking about the taxable income. Remember, the taxable income is after deducting the personal allowance there. That gives us taxable income. So we're taxed on our taxable income. If we have non-savings, you know what it is: trading profit, employment income, and or property income. If we have such, then we have a basic rate band that up to £37,500 worth of taxable non-savings income. It's what we call basic rate, and it's a 20% charge. But you go above £37,500 of taxable income, and on that excess, this is a progressive taxation. The basic rate is at 20, then you move into the higher rate band, and the higher rate, as indicated there, whoa, that's a big change. You've got a doubling in the tax rate to a very serious number indeed, 40%. So when it comes to tax planning issues, a lot of it for, shall we call them, normal taxpayers, is trying to avoid being taxed at the higher rate. It is very obvious, isn't it, that you would rather have your income taxed at 20 than on some of it suffer tax at 40%. We'll see what those planning issues are later in this chapter, and indeed then again in chapter 26, where we look at an entitled chapter, or you indeed will be looking at that chapter, tax planning questions, where we bring together the knowledge, the technical frameworks that we have used over the instructive chapters to say, well, what about in this planning scenario, in this situation, what could be done? And that's the sort of issue that is now currently likely to be tested as the 10-mark question within section C of the paper. But more of that later. We can see here the chapters given over to these areas. Trading profit is huge in terms of its content because we see chapters 4 through to 8 there. So we've got some 5 chapters given over to looking at that one source of income. Now you already know a couple of the problems that we have to deal with here. You already know that the net profit at the bottom of your statement of profit or loss for the business, that net profit, though perfectly acceptable for taxation purposes, is not acceptable for, did I say taxation? Though perfectly acceptable for accounting purposes and you know how to produce a set of accounts on that basis, it's not acceptable for taxation purposes. What we have to do is to adjust it. In Chapter 4, we look at the rules, which are mostly a disallowance of certain items of expense. There are certain types of income also that would be excluded in deriving the trading income, not usually because they're exempt, but simply because they're taxed in a different part of the computation, like property income, for example, or interest income. So, trading profit, Chapter 4, how do we adjust those accounting profits to make them acceptable for taxation? One of the main adjustments that we'll ever see, and usually the first one that we ever learn, is a very usual debit on your statement of profit or loss is depreciation. Now, what's depreciation? Depreciation is simply writing off the cost of an asset over its useful economic life there. We're just writing it off. But when you charge depreciation, there's a whole lot of different bases you could use. Straight line, reducing balance, 5%, 50%, any percentage you choose. And that's a flexibility in terms of deriving a profit figure that you would then be taxed on that HMRC cannot go along with. So what HMRC do in Chapter 4, you'll see an add back, a disallowance of the depreciation charge on your statement of profit or loss. But though that increases the profit, we add it back to the net profit. That's our starting point. We don't produce an entirely new profit and statement of profit or loss for taxation purposes. We start with what the accounts give us, a net profit. But if any expenses have been deducted in deriving it that are not allowable for taxation, according to HMRC rules, we add it back. So the depreciation will be added back. It will increase what the accounting profit would otherwise have shown to create our taxable profit, our adjusted trading profit. But what HMRC take away with one hand, they give back with the other, because they replace the disallowed depreciation charge with something called capital allowances, that in relation to capital expenditure, they'll give a tax allowance, a capital allowance. And that, and again, a hugely important chapter in the context of your examination, it is Chapter 5, where we see how to determine the level of capital allowances for the business's accounting period to be deducted in deriving the overall tax-adjusted trading profit of the period. We also have seen in our first lecture that we have a problem very specifically on trading income. Statements of profit or loss can be produced to any date, any accounting period end date that the business chooses. But our tax year runs from the 6th of April to 5th of April. So we need a basis of assessment by which we can relate any accounting period for which a profit or indeed a loss has been made to the tax year in which, if it's a profit, it will be assessed, or in relation to a loss, the year in which the loss arises, and from which then the various loss reliefs, as we've discussed briefly already, may be determined. So Chapter 6 deals with the bases of assessment for trading income. Chapter 7 deals with loss reliefs there. The different loss reliefs we have. You have a choice. Now, the interesting bit there is, once we've learnt the rules about what each of those separate loss reliefs would allow you to do, you then need to exercise that choice in terms of, well, how do I get the best use out of that loss? That's Chapter 7. And finally, Chapter 8 there, when we talk about unincorporated traders, we're not just talking about a sole trader. We're talking about partnerships as well. So everything that we've said so far about adjusting up the accounting profit to make it acceptable for tax purposes, computing and deducting capital allowances, determining bases of assessment, determining loss reliefs, all of that stands true in the context of a partnership. But we've got one original problem then to deal with. and that is if you have a tax-adjusted trading profit or loss for an accounting period, where it's a sole trader, all of that profit or loss belong to one person, the sole trader. Now it needs to be split, doesn't it, between the partners. So how do we determine how much of that profit or how much of that loss should be allocated to each partner? Because it is not the partnership that will be charged to tax. It is each partner will be charged to income tax on their share of the adjusted trading profit of the period. In terms of losses, again, it's not the partnership that has a loss to use against the partnership's profits. No, that loss needs to be divided between the partners. So how do we divide up partnership profits or losses? Very easily. You'll know from your accounting studies, no doubt already, that we will use the profit sharing agreement in force during the accounting period of profit or indeed loss. That profit sharing agreement, that is what we will use. So we will be able to then determine an adjusted profit, an adjusted loss for each partner for each accounting period. Then it's business as usual, as you would deal with a sole trader, so we then deal with each individual partner. So lots of lovely things there awaiting us in the context of chapters 4 through to 8. Employment income is also huge. It's only got one chapter, but oh, it's a big chapter. Again, chapter 2 here as we're dealing with now, and chapter 9 are probably two of the biggest chapters. The only other two large chapters are when we look at a complete tax in one chapter, inheritance tax dealt in one chapter, VAT dealt with in one chapter. But in terms of income tax, chapter 2 and chapter 9 are the big ones there. Employment income, you might think it easy. What we've seen already is, what's the normal employment income? You have a salary, you have a wage. We know that tax is collected at source by employers through the pay-as-you-earn system, based on your weekly wage going through the tax year, based on your monthly salary going through the tax year. But of course, employment income isn't just made up of salaries and wages. Well, I say that for the vast majority of taxpayers, that's exactly what it's made up of. You have a salary, you have a wage. But there will be, in any exam question anyway, a lot of other very interesting things to deal with. In addition to your salary or wage, there may be bonuses that you have earned in relation to your performance or the company's, the business performance. There may be commission. You work in sales and therefore a part of your income is commission. There may be benefits that the employer provides. And that's where most of the work in chapter 9 actually lies, in looking at the different types of benefit, separating out what are exempt benefits that an employer may provide for an employee without any chargeability to tax on the employee, and comparing that with those that are taxable. And for each individual assessable benefit, there has to be a basis by which it is assessed. So again, sorry to tell you this, a whole load of rules that there will need to be learnt. Though again, you'll be helped in that process by the information provided on your rates and allowances pages there. And as we'll see after chapter 2, property income there in chapter 3, again, the same problem exists here. How do we determine the amount of property income to be charged on the taxpayer in relation to a tax year? And often property income, it's a little bit like trading income that you see in chapter 4, inasmuch as there is a source of income quite clearly. You have a rental property, and that rental property generates rental income. But you also incur expenses. So you've got to do like a little profit and loss account in terms of, or is it probably truer to say, income and expenditure account here, in relation to, so there's a rental income coming in, there are expenses being paid out, what profit or indeed loss there arises in relation to your property income overall. Chapter 3 deals with that. One or two other little issues as well. Right, that said, how do we then calculate this tax and use those tax rates? Well, here, as you'd expect example 1 to be, a very simple example indeed. We've got to calculate the income tax payable. Now remember, income tax payable, that was tax liability less the PAYE. So here, Mr. Smith has been working for many years, received a salary. So we have employment income, and that employment income is a set £62,500 per year. That was the figure in 1920, and they'll always give you salary figures gross, i.e. before any deductions have applied, and if PAYE is relevant, they'll then tell you the amount of PAYE that had been deducted, which in our tax year here came to some £12,000. He has no other sources of taxable income. Now, here and in the answer that we'll look at in a moment's time, we would see that there's actually no reason for all of your analysis columns to be used. There is one source of income. It is clearly non-savings income. So our first task on the income tax computation, list out the sources of taxable income. There's one, salary, employment income, £62,500. It is what type? It's non-savings. No other sources of income, but of course there is a deduction, the routine deduction of the personal allowance. A personal allowance, look at your rates and allowances page, if you don't already remember it, £12,500. So we'll take the £12,500 away, deducted from the £62,500 non-savings figure of income, your employment income, and that will give you your taxable income. You will then proceed to use those tax rates as identified there, up to £37,500 at 20% and above £37,500 up to the level of taxable income. Not a difficult number. 62.5 less 12.5 personal allowance will of course be 50,000 at 40%. You don't need me to show you how, therefore, I think to do that calculation. You don't need a fully structured computation. You know you've got non-savings income 62.5, take away your personal allowance, get your taxable income. It's all non-savings. Apply the relevant tax rates as you see there. Okay, pause now while you do that, and then we'll come back, look at the answer together and move on to rather more interesting examples. Well, hopefully there were no surprises for you there, where as you see the answer as shown. Now I've done the proper columnar format here for the only analysis column that is required, non-savings. Obviously, if you get a section C question, you're going to do the full pro forma. And obviously, equally obviously in a section C question, there's going to be rather more than just one source of income. You're going to have a range of different sources of income, probably encompassing all three analysis categories of non-savings, savings and dividend. And then also through basic, higher rate, maybe even into additional rate and various other issues to come up to a 15-mark question. What you're doing here is basically a 2-mark objective testing question where you don't have to worry about layout. You don't even have to write anything down. You can put it all through your calculator if you were happy enough to be able to do that. And all we had to do here was to take our £62,500 of employment income, as we said, take away your personal allowance, get your taxable income, and then proceed to apply your basic rate band limit, £37,500, taken straight off your rates and allowances page. We've got 50,000 taxable income, so that leaves a further 12,500 to be taxed at, as we know, the much higher rate, the higher rate of 40%. Calculate your tax liability first of all, which is just the summation of the figures of tax on each band of taxable income. But as they want tax payable, we will take away the PAYE, the tax suffered at source, to bring you down to that tax payable figure. So on all of the answers to all of the examples in this chapter, what I'll be doing is to show the analysis columns. getting you into good habits. You then, through practice, will be able to develop the ability to know where you do need to put down the full analysis, even in terms of answering a 2-mark Section A objective testing question, and where you don't. You will be able to use these as tools. It's very difficult to begin with because it's all new. But once you practice, it's like anything. You get better, you get stronger, you get more confident, and you're able to make your decisions about how to approach a particular issue. You will use them as tools. At the moment, those tools you will find constraining. How do I deal with this? But come the day, once you've practiced, it will become second nature, and you'll be able to use those tools rather more creatively to be able to manufacture an answer based on the information provided in the simplest way. That's specifically an issue for OT questions where it's either right or wrong. There's nothing in between. And you've got to make sure you don't waste time. There's no presentational issues. That is purely the domain of Section C. So hopefully no technical problems there. We just for one moment go back to the notes here. That brings us to an end on non-savings income. And it will take us, but not in this lecture, through to savings income. Savings income is the big one. And again, when we move into it, we will see that there are various more interesting issues over and above what we have just seen there on non-savings. And that is going to be deserving of a lecture all in its own right. You can look forward to that, therefore, next time.